Everyone thinks they understand when a stock is a good investment. But here's something nobody can explain. Why do some of the most hyped, most talked about, most exciting stocks in the market consistently destroy more wealth than they create? I'm not talking about penny stocks or obvious scams. I'm talking about companies that had billion-dollar marketing budgets, CEOs on the cover of magazines, and entire financial media ecosystems built around promoting them. So I spent months digging through SEC filings, tracking pump and dump patterns, analyzing the language used in investor presentations, and studying the psychological warfare tactics that Wall Street uses to separate you from your money. And what I found is nothing like the story the public believes. Here's the problem. Companies with the worst fundamentals, the most questionable business models, and the most likely path to bankruptcy often have the highest retail investor enthusiasm. That should be mathematically impossible. Bad companies should have low stock prices and low interest. Yet somehow, the worse the company, the more people want to buy it. How is that possible? My name is Tom, and I spend way too much time thinking about how narrative manipulation destroys portfolios. If you're someone who's ever bought a stock because it had an exciting story, because everyone was talking about it, or because you felt like you were missing out on something big, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because what I'm about to show you will fundamentally change how you evaluate every investment for the rest of your life. Now, most people think they avoid bad stocks by doing the obvious things. They look at analyst ratings, strong buy recommendations from major firms. That means it's safe, right? They watch CNBC and Bloomberg. If Jim Cramer is pounding the table for it, it must be legit. They read the headlines. If the company just announced a partnership with a major tech giant, or they're entering a massive new market, or they hired some big name executive, that's bullish news. They check social media sentiment. If everyone on Reddit or Twitter is excited about it, if the stock has its own community of passionate believers, that validates the investment thesis. Here's the thing. Every single one of those signals is not just useless, it's actively dangerous. And I can prove it mathematically. A study published in the Journal of Financial Economics in 2019 analyzed over 15,000 stocks across a 20-year period. They found that stocks with the highest social media buzz, the most mainstream media coverage, and the strongest retail investor enthusiasm underperformed the market by an average of 8.3% annually. Not slightly underperformed, dramatically underperformed. Meanwhile, stocks that nobody talked about, that had boring businesses and generated zero headlines, outperformed by 6.7% annually. That's a 15% annual performance gap. Over 20 years, that difference turns $100,000 into either $2,800,000 or $630,000. Same time period. The only difference is whether you bought what everyone was talking about or what nobody cared about. So something else is going on here. Something that has nothing to do with the surface level explanations we tell ourselves about why we invest in certain companies. Stock investing isn't really about analyzing businesses anymore. For most retail investors, it's a psychological manipulation system disguised as financial markets. And here's what most people don't realize. The companies that are best at manipulating your psychology are almost always the worst actual investments. Because if they were good investments, they wouldn't need to manipulate you. The math would speak for itself. Let me show you exactly how this works. In 2020, a company called Nikola Motors went public through a SPAC merger. The company was valued at $34 billion at its peak. $34 billion. For a company that had never sold a single product, never generated a single dollar of revenue from actual customers. But the story was incredible. They were going to revolutionize trucking with hydrogen-powered semi-trucks. They had partnerships announced with major companies. Their founder, Trevor Milton, was being compared to Elon Musk. The narrative was perfect. Clean energy, disrupting a massive industry, visionary founder. Media coverage was everywhere. Here's what nobody was paying attention to. If you actually read their investor presentation, and I mean really read it, not just look at the pretty pictures and exciting projections, the numbers made absolutely no sense. They were projecting to go from zero revenue to $600 million in revenue in 2 years, then to $3.2 billion the year after that. A company that had never manufactured a single vehicle was going to scale production faster than Toyota, faster than Ford, faster than any automotive company in history. The capital requirements alone for that kind of scaling would be astronomical. We're talking tens of billions in factory construction, supply chain development, and R&D. But their cash position and funding runway didn't support it. The math didn't work. It was impossible. But the story was so good that nobody cared about the math. The stock hit a peak of $93.79 per share in June of 2020. Institutional investors knew it was garbage. SEC filings show that insiders were selling hand over fist at the peak. Trevor Milton personally sold $70 million worth of stock. Think about that. The founder and CEO, the guy who supposedly believed in this vision more than anyone, was dumping his shares while telling retail investors that this was just the beginning. Within 3 months, a short seller report exposed that their big product demonstration, the one that went viral and convinced thousands of people to invest, was fake. The truck wasn't driving under its own power. They had rolled it down a hill. The entire thing was theater. The stock collapsed. Trevor Milton was eventually charged with fraud by the SEC and is now serving a 4-year prison sentence. People who bought at the peak lost 97% of their money. Now you might be thinking, okay, but that's an obvious fraud case. That's not the same as legitimate companies with good stories. And that's exactly the problem with how most investors think, because the line between aggressive marketing and fraud isn't where you think it is. And the psychological techniques used to get you to buy are identical whether the company is legitimate or not. This is where it gets really interesting. The stock market has become a narrative delivery system, and the financial industry has spent decades perfecting the science of which narratives make you buy. They've studied the exact words, the exact imagery, the exact emotional triggers that bypass your rational brain and make you want to be part of the story. A researcher named Robert Shiller, who won the Nobel Prize in economics, studied this extensively. He found that stock price movements have almost no correlation with actual business performance in the short to medium term. Instead, they correlate with narrative strength. When a compelling story enters the market, money flows toward it regardless of fundamentals. And here's the kicker. The more emotionally compelling the narrative, the worse the eventual returns. Because emotional narratives attract emotional investors who don't do math. They just want to feel like they're part of something exciting. Let me give you the 3 warning signs that a stock is built on narrative manipulation rather than actual value. These are the red flags that appear in almost every major retail investor wealth destruction event of the last 20 years. And I'm going to show you exactly how to spot them before you lose money. Warning sign number 1. The company's investor presentation focuses more on market size than on competitive advantage. Here's what this looks like in practice. You're reading about a company, and they start with something like, the global widget market is worth $500 billion and growing at 15% annually. We're positioned to capture just 3% of this massive opportunity, which would make us a $15 billion company. Sounds exciting, right? Massive market, tiny market share needed, huge upside potential. This is a red flag, and here's why. Market size means absolutely nothing if the company has no defensible way to capture that market. I could start a company tomorrow and say, I'm entering the smartphone market. The smartphone market is worth $500 billion annually. If I capture just 1%, I'll have a $5 billion company. Cool. How exactly am I going to take market share from Apple and Samsung? What do I have that they don't? What stops them from copying anything I do? The answers to those questions are what actually matter. But companies built on hype never answer them. They just point at the big number and let your brain fill in the rest. WeWork did this perfectly. Their investor presentations obsessed over the size of the commercial real estate market. Trillions of dollars, massive opportunity, global expansion potential. What they didn't talk about was their complete lack of competitive advantage. They were signing long-term leases and offering short-term subleases. Any real estate company could do that. There was no technology moat, No network effects, no proprietary anything. They were just losing money on every transaction and trying to make it up in volume, which is literally impossible. But the narrative was so strong, the market size so big, the vision so compelling, that SoftBank valued them at $47 billion in 2019. Within months, the company nearly went bankrupt and is now worth less than $5 billion. People who bought into the IPO hype would have lost over 90%. Here's the test. When you're evaluating a company, ignore every slide about market size. Instead, ask yourself, what does this company have that competitors can't replicate in 12 months? If you can't answer that question with something specific and defensible, you're looking at a narrative play, not an investment. Warning sign number 2. The company is constantly announcing partnerships and deals, but never shows the financial impact. This one is subtle but devastating. Companies that are struggling to gain real traction have figured out that announcing partnerships generates headlines and moves stock prices, even when those partnerships are essentially meaningless. So they do it constantly. They announce a pilot program with a major corporation. They announce a memorandum of understanding with a foreign government. They announce a strategic collaboration with a well-known brand. Each announcement gets covered by financial media. Each one trends on social media. Each one brings in a new wave of retail investors who think, wow, if this major company is working with them, they must be legit. But here's what most people don't realize. Most of these announced partnerships have no guaranteed revenue, no exclusivity, and no binding commitments. A pilot program means a big company agreed to test the product with no obligation to buy it. A memorandum of understanding means absolutely nothing legally. It's a fancy way of saying we had a meeting and might work together someday. A strategic collaboration often just means we're going to explore opportunities, which is corporate speak for we shook hands and took a photo. I watched this play out with a company called Lordstown Motors. Between 2021 and 2021, they announced partnerships and pre-orders from multiple fleet operators, major companies, huge numbers of vehicles, tens of thousands of trucks pre-ordered. The stock went from around $10 to over $30 per share on this news. Retail investors piled in thinking, these are real orders from real companies, this is validated demand. Then the short sellers dug into the details. Those pre-orders were non-binding, no deposits required, no penalties for cancellation. They were essentially letters of interest. And when reporters called the companies that had supposedly pre-ordered, several said they had no firm plans to actually buy the trucks. It was all narrative. Lordstown eventually admitted they had overstated demand and the CEO resigned. The company filed for bankruptcy in 2023. Investors lost everything. Here's the test. When you see a partnership announcement, go to the SEC filings. Look for the 8K form that companies must file when they enter material agreements. Read the actual contract details. How much guaranteed revenue does this generate? What are the specific financial commitments? If the partnership was really material to the business, it would be detailed in the filings. If it's just a press release with no corresponding SEC filing, it's narrative manipulation. Warning sign number 3, and this is the big one. The company's valuation is based entirely on what it might become, with no path showing how it gets there. This is the final and most dangerous red flag. It's when a company is valued as if it's already a successful, dominant player in its market, despite currently having minimal revenue, massive losses, and no clear timeline to profitability. The valuation is based purely on the story of what could happen if everything goes perfectly. Look, I'm not saying growth companies should be profitable immediately. Amazon wasn't profitable for years, and that turned out okay. But Amazon had a clear path. They were reinvesting every dollar into building infrastructure that had obvious value. Warehouses, logistics networks, technology systems. You could see where the money was going and how it would eventually generate returns. The path was visible even if it would take years to play out. Narrative-driven companies don't have that. They just have projections. Hockey stick graphs showing explosive growth starting next quarter. Always next quarter. And when next quarter comes and growth doesn't materialize, they have an explanation, and the hockey stick gets pushed out another quarter. This cycle repeats until either the company collapses or enough time passes that everyone forgets the original projections. Let me show you the math on why this matters. In 2021, a company called Arrival was valued at $13 billion. They were going to manufacture electric vans using a revolutionary microfactory approach. The story was incredible. Lower capital costs, faster scaling, purpose-built vehicles, the future of delivery. At the time of that $13 billion valuation, their annual revenue was $0. Not low revenue, zero. They projected they would reach 21,000 vehicles delivered in 2023. That would generate approximately $1.1 billion in revenue based on their stated vehicle prices. So the market was valuing them at 12 times their projected revenue 3 years in the future. For a company that had never manufactured a single vehicle, never proven they could build the microfactories, never demonstrated unit economics. Traditional automotive companies like Ford were trading at about 0.4 times revenue at the same time. So the market was saying that Arrival, a company with no revenue, no proven manufacturing capability, and no vehicles on the road, was worth 30 times more per dollar of projected future revenue than Ford, a company that builds millions of vehicles per year profitably. That's insane. And it was entirely based on narrative. The story was so compelling that math didn't matter. Fast forward to today. Arrival has delivered approximately 0 vehicles. The stock has collapsed from peak values of around $37 to under 10 cents. The company is essentially defunct, but here's what kills me. This was completely predictable. If you just did basic math on capital requirements for automotive manufacturing, you could see it was impossible. Building even one factory to produce thousands of vehicles cost hundreds of millions of dollars. They didn't have that capital. Their burn rate was over $200 million per year just on R&D and overhead. The timeline to revenue meant they would run out of money before getting to production scale. The math showed bankruptcy was the most likely outcome from day one. But the story was too good. People wanted to believe. Here's the test. Take the company's current valuation and divide it by their projected revenue 3 years from now. If that multiple is higher than established companies in the same industry, you need an extraordinary explanation for why. Not a story about disruption or innovation. An actual explanation with specific competitive advantages that justify the premium. If you can't articulate that in concrete terms, you're paying for narrative, not value. Now, here's what most people don't understand about why these narrative-driven investments are so dangerous. It's not just that they're overvalued. It's that the entire ecosystem around them is designed to keep you holding while insiders exit. The narrative doesn't just get you to buy. It gets you to not sell, even as the company fails. Because selling means admitting you were wrong. It means you weren't part of the smart money who saw the future. It means you gave up on the dream. The psychology of sunk costs and identity makes you hold losing positions way longer than you should. And that's exactly what the system counts on. When Theranos was collapsing, Elizabeth Holmes kept promising investors that the breakthrough was just around the corner, that the technology would be validated soon, that the critics were wrong and the believers would be proven right. People who had invested millions held on because selling meant admitting they'd been fooled. Some investors put in additional money trying to average down their cost basis. The narrative was so strong that even as overwhelming evidence emerged that the technology didn't work, some investors still believed. They lost everything. The financial industry knows this. They've studied the psychology extensively, and they've built an entire infrastructure around exploiting it. Investment banks take companies public at inflated valuations, collecting massive fees. They know retail investors will buy the story. Insiders sell their shares to those retail investors at peak prices. Financial media covers the story breathlessly because it generates clicks and views. Social media amplifies the excitement because emotional content spreads. And retail investors, the last ones into the trade, are left holding the bag when reality catches up to the narrative. A study by researchers at the University of Florida analyzed over 6,000 IPOs from 1,980 to 2019. They found that companies with the highest media coverage before going public underperformed the market by an average of 12.4% in the first 3 years after IPO. Meanwhile, companies that went public quietly with minimal hype outperformed by 7.2%. That's nearly a 20% performance gap. The hyped companies weren't worse businesses necessarily. They were just priced for perfection based on narrative, which meant any stumble led to massive losses. The quiet companies were priced for reality, which meant positive surprises led to gains. Think about what that means. The stock you're most excited about, the one everyone is talking about, the one with the inspiring founder and the world-changing vision, is statistically likely to be one of your worst investments. Not because the company will necessarily fail, but because you're paying a narrative premium. You're buying the story, and stories are worth exactly $0 in cash flow. So how do you actually protect yourself from this? How do you separate legitimate growth companies from narrative-driven wealth destroyers? I'm going to give you the exact framework I use to evaluate every investment. This is in theory. This is the actual checklist that has kept me out of every major retail investor disaster of the last decade, while still allowing me to invest in real growth opportunities. Step 1, read the actual SEC filings, not the investor presentation. Companies are legally required to disclose risks and material information in their 10K annual reports and 10Q quarterly reports. These documents are boring. They're written in dense legal language. They're hundreds of pages long. That's exactly why you need to read them. Because the things that will kill your investment are buried in these documents, not highlighted in the glossy investor deck. Look specifically for the risk factors section. This is where companies have to disclose everything that could go wrong. If a company lists 30 or 40 different risk factors, and many of them relate to whether the core business model actually works, that's a massive red flag. Established companies with proven models have risks around competition and market conditions. Narrative companies have risks around whether they can execute on any part of their plan. Step 2, follow the insider trading. Insiders, the executives and board members, have to report their stock transactions to the SEC. You can see this data for free on the SEC website or through various financial sites. If insiders are selling significant portions of their holdings, that tells you everything you need to know about what they really think of the company's prospects. Now, some insider selling is normal. Executives get paid in stock and need to diversify their wealth. But when you see the CEO, CFO, and multiple board members all selling large percentages of their holdings around the same time, especially when the stock is at high valuations, that's a screaming signal to stay away. They know more than you do, and they're exiting while retail investors are entering. Step 3, calculate how much cash the company burns per quarter and how many quarters of runway they have. This is simple math, but incredibly powerful. Look at the cash flow statement in the most recent 10Q. Find the line for cash used in operating activities. That's the burn rate. Now look at the balance sheet and find cash and cash equivalents. Divide the cash by the quarterly burn rate. That tells you how many quarters until they run out of money. If the answer is less than 8 quarters, and the company isn't clearly on a path to profitability or doesn't have committed funding lined up, you're looking at a potential 0. Because when they run out of money, they'll either have to raise more capital by diluting existing shareholders, or they'll go bankrupt. Either way, your investment loses value. Step 4, and this is crucial. Demand that the company's valuation makes sense, even if they only achieve half of their stated goals. This is the margin of safety principle that Benjamin Graham taught and Warren Buffett practices. Don't invest in a company where you need everything to go perfectly for the investment to work out. Invest in companies where even if things go moderately wrong, you'll still make money. If a company is valued as if they're definitely going to capture 10% of a market, but their valuation would be destroyed if they only capture 3%, that's too risky. You're not investing, you're speculating. And speculation based on narrative is how people lose their life savings. Let me show you what this looks like in practice with a real example. In 2019, I was looking at Beyond Meat, right after their IPO. The story was incredible. Plant-based meat alternatives, massive environmental benefits, health benefits, major restaurant partnerships, celebrity investors. The stock went from $25 at IPO to almost $240 within a few months. Everyone was talking about it. The narrative was perfect. This was the future of food. So I did the math. At a stock price of $200, the company was valued at about $12 billion. Their revenue at the time was around $90 million quarterly. So they were trading at over 30 times sales. For context, established food companies like Tyson Foods were trading at about 0.6 times sales. So the market was saying Beyond Meat was worth 50 times more per dollar of sales than Tyson. Why? Because of the growth narrative. They were projected to grow revenue by 50 to 60% annually. Okay, let's test that. If they grew at 50% annually for 5 years, they'd get to about $3 billion in annual revenue. If they could maintain a 10% profit margin, which would be exceptional for a food company, that's $300 million in annual profit. At a standard price to earnings ratio of 25, that would justify a market cap of $7.5 billion. But they were already valued at $12 billion. So I need them to not just hit their aggressive growth targets, I need them to exceed them. And I need profit margins better than almost any food company in history just to justify the current price. There was no margin of safety. I passed on the investment. Today, Beyond Meat trades at around $6 per share, down 97% from the peak. People who bought into the narrative at $200 lost almost everything. Not because the company failed completely. They still exist. They still sell products. But the valuation was based on a perfect narrative, and reality is never perfect. Here's what nobody tells you about narrative-driven investing. The people promoting these stories aren't stupid, and they're not all frauds. Many genuinely believe in the vision. The problem is that belief and investment value are completely different things. You can believe in a company's mission, admire their innovation, and think they're doing important work, while simultaneously recognizing that the stock is a terrible investment at the current price. Those two things aren't contradictory. In fact, the ability to separate them is what defines successful investors. The hard truth is that the financial system is designed to extract money from people who invest based on emotions and stories. Not because there's some evil conspiracy, but because emotional investors make predictable mistakes, and those mistakes create profit opportunities for more disciplined investors. When retail investors pile into a hype stock and drive the price to irrational levels, institutional investors and insiders sell to them at those levels. When the stock eventually crashes back to reality, those same institutional investors buy back in at reasonable prices. The wealth doesn't disappear, it just transfers from the emotional investors to the patient ones. A study published in the Review of Financial Studies tracked this pattern across thousands of stocks over 30 years. They found that stocks with high retail investor ownership and high social media buzz experience predictable boom and bust cycles. Prices would spike on narrative, retail would buy at the peak, insiders would sell, then prices would crash as reality disappointed compared to expectations. This pattern was so consistent that the researchers built a trading strategy around it. They would short stocks when retail enthusiasm peaked and buy when it bottomed. This strategy generated average annual returns of 18.3%. Think about that. The predictable emotional patterns of retail investors were so reliable that you could build a profitable strategy purely around fading their enthusiasm. You might be thinking, okay, but sometimes the narrative-driven companies do succeed. What about Amazon? What about Tesla? Weren't those narrative plays that actually worked out? And yes, absolutely. Some narrative-driven investments do succeed spectacularly. But here's what you need to understand about survivorship bias. For every Amazon and Tesla, there are hundreds of Pets.com, Webvan, Theranos, Nikola, and WeWork. The question isn't whether it's possible for a hyped company to succeed. The question is, what are your actual odds? And the data is clear. Stocks trading primarily on narrative rather than current fundamentals have much higher failure rates than the market average. A comprehensive study by Hendrik Bessenbinder at Arizona State University analyzed the performance of every stock in the US market from 1,926 to 2019. That's over 26,000 different stocks across 93 years. His findings were shocking. Only 4% of stocks accounted for all of the market's gains above Treasury bills. 4%. The other 96%, as a group, essentially matched the return of risk-free government bonds. More than half of all stocks produced negative lifetime returns. The vast majority of individual stock picking leads to underperformance. And the stocks most likely to underperform were those with the highest valuations relative to current fundamentals. In other words, the narrative plays. So when someone points to Amazon as proof that you should buy hyped growth stocks, they're showing you the 4% that worked while ignoring the 96% that didn't. That's not an investment strategy. That's lottery ticket thinking. And the house always wins in the lottery. Here's the framework that actually works. Invest in companies where the current business alone, without any growth assumptions, justifies a reasonable portion of the current valuation. Then, growth is upside, not a requirement. This is how Buffett invested in Coca-Cola. When he bought it, Coke was already massively profitable with global distribution. The valuation was reasonable for the existing business. Then decades of growth created extraordinary returns. But he didn't need that growth for the investment to work. It was margin of safety. Compare that to how most retail investors approach narrative stocks. They invest in companies with no current profits, assuming future growth will justify today's valuation. That's backwards. You're paying today for something that might happen tomorrow. And you're doing it in competition with professional investors who have better information, better analysis, and will exit before you do when things go wrong. So let me give you the 3 specific actions you need to take right now to protect yourself from narrative-driven wealth destruction. Action 1. Go through your current portfolio and for each position, write down the specific, measurable financial metrics that justify your valuation. Not the story, not the potential, the actual numbers. If you can't point to current revenue, profit margins, cash flow, or tangible assets that justify a meaningful portion of what you paid, you're holding a narrative position. You need to seriously consider whether that's appropriate for your risk tolerance and what percentage of your portfolio it should represent. I'm not saying sell everything. I'm saying be honest about what you own. Action 2. Create a personal rule that you will never invest more than 5% of your portfolio in any single company that isn't currently profitable. This forces discipline. You can still take shots on growth stories and speculative plays, but you're limiting your downside. The math is simple. If you put 5% into a narrative play and it goes to 0, you lose 5% of your portfolio. Painful, but survivable. If you put 30% into a narrative play and it goes to 0, which happens regularly, you've devastated your financial future. Don't let a good story destroy your financial security. Action 3. Before buying any stock, write down 3 specific things that would make you sell. Not price targets. Specific business developments that would indicate your investment thesis is wrong. Maybe it's insider selling above a certain threshold. Maybe it's missing revenue projections 2 quarters in a row. Maybe it's cash runway dropping below 6 quarters. Whatever it is, define it before you invest. Because once you own the stock, your psychology changes. You become emotionally invested in being right. You'll rationalize negative developments and hold losing positions way too long. Having predefined exit criteria that you committed to before the emotional attachment formed is the only way to maintain discipline. Look, I get why narrative investing is so appealing. It's exciting. It makes you feel like you're part of something important. It's way more fun to tell people you're invested in the company that's revolutionizing transportation or curing cancer than to say you own boring industrial companies that make slightly higher profits each year. The narrative gives you an identity. It makes investing feel meaningful rather than just mechanical wealth building. And the financial industry knows this. They know that selling you a story is way more profitable than selling you a boring value investment. Because stories generate trading activity. Stories make you check your portfolio constantly. Stories make you tell your friends. Stories go viral on social media, and all of that activity generates fees and commissions for the financial industry. But here's the thing. Your portfolio doesn't care about meaning or excitement or being part of a movement. It only cares about math, cash flows, profit margins, return on invested capital, valuation multiples. The boring, unglamorous numbers that actually determine whether you build wealth or lose it. Every dollar you invest based on a story rather than numbers is a dollar you're gambling with, and the house advantage in that gamble is significant. I've watched thousands of people lose money on narrative investments over the years, and the pattern is always the same. They hear an exciting story, they do just enough research to confirm what they want to believe. They invest money they can't afford to lose. They ignore warning signs because they're emotionally committed. They hold through devastating declines because selling means admitting they were wrong. And eventually, they capitulate near the bottom, locking in massive losses. Then they tell themselves they'll be more careful next time. But next time, there's a new story, a new narrative, a new company that's going to change the world, and the cycle repeats. The only way to break this cycle is to fundamentally change how you evaluate investments. Stop asking whether the story is exciting. Start asking whether the math makes sense. Stop asking whether the company could be huge. Start asking what happens if they're only moderately successful. Stop asking what the stock price could go to. Start asking what the business is actually worth today. This shift in perspective is uncomfortable because it takes all the fun out of investing. But it's also what separates people who build lasting wealth from people who get churned through the narrative hype machine every market cycle. Right now, there are dozens of companies trading on nothing but narrative. Quantum computing companies with no revenue, artificial intelligence companies with no proprietary technology, space exploration companies with no clear path to profitability, biotech companies with no approved drugs. And all of them have exciting stories. All of them have passionate believers. All of them are featured regularly in financial media. And the vast majority of them will destroy shareholder value over the next 5 to 10 years. Not because the technology is impossible or the vision is wrong, but because the valuations already assume perfect execution and then some. Your job as an investor isn't to predict the future or identify the next world-changing company. Your job is to buy assets for less than they're worth and avoid overpaying for stories. That's it. That's the entire game. Everything else is noise designed to make you deviate from that simple principle. The 3 warning signs I showed you today, focus on market size over competitive advantage, constant partnership announcements with no financial impact, and valuations based purely on future potential, these appear in almost every major retail investor disaster. If you can learn to recognize them and have the discipline to walk away no matter how exciting the story is, you'll avoid 90% of the wealth-destroying investments out there. And here's the beautiful part. You don't need to invest in narrative-driven stocks to build wealth. The boring companies with sustainable competitive advantages, reasonable valuations, and consistent cash flows will make you rich over time. They just won't make you feel like a genius at cocktail parties. But I'd rather be actually rich than feel smart while losing money. The market doesn't pay you for having opinions about the future. It pays you for being right about value. And value is determined by math, not stories. Learn to love the math. Learn to distrust the stories, and you'll be fine.